There are some budget announcements that amount to little more than tinkering by the Chancellor of the day. The budget announced by Rachel Reeves this week was not one of them. We knew that some pretty big measures were on the way in terms of both tax and spending, and so it proved 41 billion in extra tax each year and 74 billion of increased spending made this a mammoth budget. To unpack it all, I'm joined by Tom Stevenson, Investment Director here at Fidelity. Tom, welcome along. You've seen plenty of budgets delivered from plenty of different chancellors. So have I, actually. In terms of scale, how significant was this budget?
Yeah, I think this is one of the biggest that I've ever seen. I mean, you mentioned some of the figures there. The scale of the spending, which Rachel Reeves announced yesterday, and how she's paying for it. 40 odd billion in higher taxes and 30 odd billion in higher borrowing is pretty substantial. Yeah, I mean, it feels to me like this is a real old Labour budget to me. I mean, this is big spending, big taxation, big borrowing. This is something we haven't seen for many years.
Yeah, it's a party that's waited a long, long time to get into power, and now they're in power. They're gonna, this sets out the stall and speaks to a politicians who have decided how they want to be remembered and what they want to do, right? I mean,
yeah, I mean, it's what they say, isn't it? To govern is to choose, and Keir Starmer and Rachel Reeves have made big choices here about the kind of the way that they want to run the economy. And the interesting thing is that clearly they were elected with a big majority, but I'm not sure that what they've presented was what they were voted to do, and that's the big gamble because I mean they have made some big choices here, and it remains to be seen A, whether the choices pay off, and B, whether they are exactly what people want.
Yeah, and we're not here to talk about the politics, but the reality of that election was there was no political pressure on them to set out in precise detail what they were going to do, and so in the kind of vacuum of that, yeah, there was nothing really that we knew about their plans, but they have made some big decisions, and I'll confess I got it wrong. I think we all got it wrong slightly in the run up to the budget. There was lots of talk, which now feels a bit stupid and besides the point, actually. But there was lots and lots of focus on tax rises. We certainly got those. But I remember saying on the podcast a few weeks ago, well, what we know for sure is that this is going to be a budget that is a constriction in terms of spending. It's going to raise money to plug black holes and what have you. What no one really saw coming was the extent of the spending and actually the extent of the borrowing that needs to happen to fund that spending.
Yeah, and that's a really interesting point because, and we were all watching very closely the market reaction to it yesterday, because I think, given the scale of the extra borrowing that we're going to see over the whole of this parliament, I think it's something like 140 billion over the 5 years. I think actually the market reaction was pretty subdued and pretty calm. I mean, there was talk yesterday about all the gilts market has fallen, bond yields are rising. I don't think they rose very much in the context of the extra borrowing that was actually announced.
Yeah, and it was interesting to see, because obviously the context of this is, people were saying, watch the bond market, it will punish a government that borrows too much and underfunds or makes unfunded promises. A lot of these promises are unfunded. I mean, or at least they're funded through borrowing. And I don't think anyone expected Labour to take this much of a gamble with the bond market in terms of the public finances.
It's quite risky. What the Chancellor announced yesterday. I mean, I think that she'll actually be very pleased and quite relieved at the reaction.
Yes, and we're going to get into the some of the measures affecting people's personal finances, but in terms of what really moved the dial in this budget, in terms of the spending commitments and the tax rises, what were the big measures on either side of the ledger?
Yeah, well, I mean, the big measure. Well, part of the spending is filling this notional black hole that she talked about. That's 22 billion of it, but there are big chunks as well just to repair the public services. So a lot of money going into the National Health Service. That's the biggest day-to-day spending, more than 20 billion day-to-day spending upfront in the next year or two in the health service, and a big chunk into education, into schools as well. So, about a third of this 70 odd billion is in capital spending. So this is a fundamental change, and you could argue that it's a long overdue change. I mean, I think the just you look around you at the sort of at the fabric of the public sphere in this country. I mean, it is clearly worse than it was 15 years ago. I mean, just I was looking at the chart actually, which I was really quite struck by this chart, which showed how big the economy would have been had we stuck to our growth trajectory before the financial crisis 15
Yeah,
years ago. And it's something like 29%. The economy would have been 29% bigger than it is today. It's hardly
yeah,
surprising in that context that the fabric of around us, the potholes in the roads, the state of the hospitals, the state of the schools, is what it is today. And that's the big decision that that Labour has taken. That actually you need to repair that in order to create the framework for growth in the future.
yeah. So a big commitment to spend more day to day and on capital projects. That's the big, spend.
Mm.
The big tax rises. There were lots of them, but one or two in particular have raised the most money, right?
Yes, so the path of least political resistance is not to do it obviously from
Hmm.
individuals. As we know, what Rachel Reeves targeted was national insurance paid by employers. So she's basically taxed businesses to raise 25 billion of that 40 billion. So the bulk of it, more than half of the taxes that she's raised, has come from businesses. So therein lies the challenge. Has what she's done, what she's trying to do is to create the put in place the foundations for a faster growing, healthier, bigger, stronger economy. The big question is whether actually in the short term what she's done makes that growth less likely to be achieved, because companies which are spending more on taxes are almost by definition will have less money to spend on staff. Wages are likely not to grow as fast as they can. They're likely to hire fewer people.
Hmm.
Arguably, in the short term, that actually reduces growth rather than promotes growth.
And that change basically did a couple of things around employer NI. It raised the rate of employer NI from 13.8% to
Yep.
15%. It also lowered the point at which that begins to apply from 9,000 ish to 5,000.
Yep.
A big right, 25 billion, I think, from off the top of my head.
Mm.
Haven't got it in front of me.
To
That
25. Yeah.
that raises.
Mm.
Um, Now, there's an argument about whether that breaks the commitment that Labour made about not raising NI. Obviously, that is national insurance. They have
Mm.
raised it, but it's not the NI that we pay as working people.
Mm.
Businesses pay it. There was a mitigation added, which is that um, there's something called the employment allowance. This is the complexities of business
Mhm.
tax, but basically, if you're a small business, well, a business, let's say, and your NI bill for employees is below £100,000, you can get this allowance basically. And that's been raised, I think, to near
Ten and a
£10,000,
half thousand.
ten and a
Yeah.
half thousand
Yeah.
pounds, which will actually, for some smaller employers, negate this tax rise, and it might even leave them better off. But obviously, not most employers are not in that and not in that boat if they're above a certain size. Um, okay, so we've covered also the market reaction to that. Let's just dwell slightly a bit more on that. Bond markets relative, there has been rises in bond yields, suggesting that there's going to be an impact on in the bond market. Stock market pretty sanguine, although it looks as though shares are beginning to factor in the chances of slower falls in interest rates
Mm.
as a result of all this.
Yeah. So the stock market reaction initially was positive in the sort of domestically focused mid cap area of the market.
You
So
could, in
the
the
FTSE
speech during her
250.
speech, actually,
Yeah,
it
it
was
actually
going
rose
up.
very, very sharply, and especially in areas like the builders, the house builders,
Yeah,
because there was what the market focused on initially was all of this spending.
yeah.
It,
Extending HS2 to Euston, all
yeah,
this sort of stuff.
yeah,
That's all great for kind of
yeah.
spades and growth and all that kind of stuff.
Yeah, and then what they kind of focused on was that actually all of this spending is quite likely to be inflationary, and that is likely to lead to interest rates staying higher than they would have been otherwise. Now, it's a fairly marginal difference. I mean, I think the market was expecting 4 or 5 quarter point rate cuts by the end of next year. It's now looking for 3 or 4. So it's not a huge difference, but at the margin, interest rates are going to stay a bit higher. Mortgages are going to stay a bit higher. And so, therefore, consumer spending and growth is probably going to be a bit lower.
Yes. And so there were some growth forecasts in the budget about inflation and about growth. What do they tell us about the path of those things over the course of this parliament?
Yeah. So, I mean, what they're suggesting is there's going to be something of a sort of sugar rush, if you like, in growth up front. A lot of the spending is front loaded, but actually, when you look further out, the growth projections by the OBR are not very exciting, really.
Hmm.
I mean, growth is in the sort of 1% range. Throughout the next five-year period. So, one of the risks is that the government spends a lot of money to achieve not a great deal
Yeah.
of higher growth.
Yeah. And those growth figures skirting around the 2% mark, really, for the next 5 years. Not that exciting, but better than we've had, with the rather large caveat that these are forecasts, and forecasts tend to be not just inaccurate, but actually optimistic. That's has been the trend. So if they were to hit those growth targets, they'd probably be satisfied with that. But there's a question.
Yeah, I mean, I think the really interesting thing about this whole budget actually is, for the first time in a long time, it is attempting to take a long term view of what needs to be done to grow the economy.
Mm.
And the risk that Labour has taken here is that actually they're not going to see the benefit in terms of growth until after the next election. So, on the OBR's forecast, we're not going to see a material pickup in growth until the middle of the next parliament. So the big gamble that Labour has taken is that they've made their plans on the basis of a 10-year projection.
Yeah.
We have a 5-year political timetable here. And that's why they front loaded so much of this. That's why so much of the spending is happening this year and next year, because they need to see material benefits at the time of the next election.
Yeah, and one of the points made in response to the budget, I think it was the IFS made this point, that a huge injection of extra spending in the next year, say on the NHS or what have you, schools, you've got to allocate that money effectively. And there's a big question about whether you can allocate that much money effectively and efficiently.
Yeah.
And also, the point was made that the spending shoots up for 2-3 years and then sort of plateaus. It's still much higher than today's level, but big increases and then it sort of levels out. Is that realistic, or are you sort of feeding a beast at that stage? And it gets hard to make the gains, the improvements in standards and waiting lists coming down, all the rest of it. Can you still do that without extra spending at that point? A tax is going to have to rise again and again and again, which will be a nasty spiral to get into.
Yeah, and history does suggest that this is the case. That when you get governments who introduce big expansionary budgets, spending increases, very often they have to do it again. 1-2 years down the
Yeah.
track. And there is a philosophical question here about who is best placed to spend this money. This is a huge expansion of the state. This is a shift from the private sector to the public sector in terms of spending money. And there'll be many people that say that governments do not have a great track record of spending money wisely. Now, there are going to be a lot of new guardrails put in place to ensure that the money, hopefully is spent well,
Mhm.
but it's a gamble.
It's a gamble, and just finally, before we move on to some of the sort of more sort of personal finance
Mm.
elements of the budget, you can see the dilemma of any government. We all want better public services. We all complain when they don't work. There is really the only way to fix that is through funding them better. So we want everything, don't we? As an electorate, we want. You say this all the time. We want Scandinavian public services, but we want American tax rates, and
Yeah.
you can't have it.
No, you can't. But clearly, what's happened
Gone more
now is we
Scandinavian.
have moved. We have moved much closer towards a European funding model than we were at before.
Yeah. Okay. Well, let's get in, Tom, to some of the details affecting personal finances from this budget. Let's start with CGT, shall we? There was lots of scary talk ahead of the budget. We did get a rise, but it was probably at the less scary end of the options available.
Yes, I mean, there was so much speculation about so many taxes, but I mean, CGT was very much in focus, and at the the worst case scenario was that the very favourable tax treatment of capital gains, 10% and 20%, broadly
Yes.
speaking, could have been aligned with income tax rates, so as high as 45%.
Hmm.
What actually happened was that the tax rates were aligned with the existing capital gains tax rates for property,
Yeah.
which were 18% and 24% for basic rate and higher rate taxpayers. So, someone making a capital gain on shares or the sale of a business or property will now pay 24% tax, which is a lot less than they will pay on their income. So it's still a favourable treatment. And I think probably that's probably quite well calibrated. I think that what the Chancellor has done there is push it as far as she can
Hmm.
without changing people's behaviour too much, so that they actually start avoiding it. Because I mean, there is a tipping point at which you don't actually get any benefit from raising tax rates, because you actually raise less tax
Yeah.
because people change their behaviour.
Yeah.
And I think pushing it to 24, 18 and 24 is probably a sensible approach.
That's right. And actually, when you look at, we're our audience for this will be lots of investors. They might have money which is exposed potentially to capital gains tax, and they'll see a rise in the rate. But probably the thing that's affected them more in recent years has been the reduction in the allowance that you have for capital
Yeah.
gains tax, down from about £12,500 to £6,000, and then to £3,000
Yeah.
pounds. So you can make that gain per year before the tax applies. That will be way more consequential than this change in the rate, I would say, because
For
that
some, it will be.
for some,
Yeah.
because with that much higher allowance, it gave you all sorts of headroom to kind of manage your losses and your gains year
Yeah.
to year, and you actually didn't often have to pay that tax, and you could
Yeah.
have very large sums outside of tax efficient wrappers like ISAs and
Yeah.
pensions, and still actually reduce your exposure to CGT. Okay. There was also, Tom, a decision to include pensions
Mm.
in estates for IHT purposes. This won't affect the majority of people, but it's going to be very, very consequential for some people, and it might necessitate the changing of retirement plans as well.
Yeah, so I think this is a big deal, and there is actually a technical consultation going on about exactly how this will be implemented, and it's not due to be implemented, I think, until 2027.
Yep.
So there is time for the government to work out exactly how it's going to do it, and even probably to change its mind
Mhm.
about it. So so I don't think we can make too many firm conclusions about what this means. But broadly speaking, this was a bit of an anomaly, that that money in your defined contribution pension was outside your estate for the purposes of IHT. So what happened was that many people were starting to use their pensions as a mechanism for handing money on through
Yep.
the generations, rather than ultimately what pensions are designed for, which is to provide an income in retirement. So it doesn't surprise me that it's been targeted by the government, but it does create this strange situation where Um, and if a very high effective tax rate could be created, because someone with a substantial pension that they that they wish to pass on to their children when they die,
Hmm.
their beneficiaries could be faced with, first of all, an inheritance tax bill of 40%.
Yeah.
And then if the death happens after the age of 75,
Yeah.
then the beneficiaries will then be hit also by a tax rate at their marginal income tax rate.
Hmm.
So if the child is a 45% tax rate payer, you pay 40%, you then pay 45% on the 60% that you've got left, you end up paying a 67% tax rate. So that is
Yeah.
a very significant disincentive to hand money on in that way.
Yes, and yeah, I've been looking at this in particular this week, and um, yeah, lots of people will have completely, made their plans, especially if they're going to pass on money and they might have an IHT liability around maintaining, preserving pension money through their retirement.
Mm.
Take income from other sources before your pension because your pension can get passed on in quite a tax efficient way.
Yeah.
Um, and now that's all completely changed. I haven't got the figures in front of me, but this is going to rapidly increase the number of people affected by IHT. I think at the last count there was something like 28,000 estates
Yeah.
in the last year that figures were available for. 28,000 estates that IHT applied, and that was about 4 to 5% of estates.
Yeah.
The government says its own projections are that this will increase. Well, another 10,500 estates are going to be
Mm.
affected by IHT now. So,
So it's
um,
quite a big percentage on the
yeah,
28,000.
yeah.
Yeah.
So a much bigger amount, still a minority probably,
Mm.
but I think there's a big range of a big possible range in that figure because, as you say, tax changes behaviours as well. So who knows what will now happen in terms of
Yeah, and I
how
think
people organise their
And I
finances.
think exactly, and I think many people are going to be looking to get some advice on how they manage their affairs, because it's very complicated. And for example, it changes the arithmetic about whether, for example, an annuity becomes attractive.
Yeah,
Because if there's much less incentive to hold on to your pension money to hand it on, it might make sense at a later stage in your retirement to look into an annuity. So there are a lot of factors that need to be considered, and I think people will want to get some advice on that.
yeah, and as you said, this decision really gets enacted in more than 2 years' time,
Mm,
and there will be lots of consultation about that. And I'm sure that people will raise, difficult cases of, maybe someone's bought an annuity, assuming they can pass on a pension pot, but
mm,
when they're buying the annuity, they haven't built in any death benefits or paid for the kind of extra protections that you might want for dependents after you die
mm,
because they've assumed that they'll pass on their pension now, or the rest of their pension. Now, obviously, tax rules can change, and you constantly get told don't plan on the basis of a tax system that can change. But how else are you supposed to do it? You
mm.
you can only do it based on the rules that are there.
At the time,
Yeah,
yeah,
at the time, and
yeah.
so yeah, watch this space for exactly how that
Mm.
change is going to be implemented. A couple of other things to cover: stamp duty. We had well, first of all, there's a reduction in stamp duty, which is not going to be extended. So, which means that stamp duty is going to apply once again on the value of properties from £125,000
Hmm.
because at the moment they're exempt up to
250.
250.
Yep.
So that's going to actually raise stamp duty in effect. But there was also another tax rise for buyers of second homes.
Yes, and this chimes with the sort of underlying premise of this budget, that people with the broadest shoulders should bear the greatest burden. And so it's not surprising that people who are in the fortunate position of being able to buy a second property should be targeted. And indeed, you currently pay a 3% extra um, stamp duty
Surcharge, yeah.
surcharge, stamp duty rate, and that's going to go up to 5%. And in stamp duty on property is already fairly significant. I mean,
Mhm.
above that allowance rate, it quite quickly gets up to 5% and then 10%,
Yeah.
and I think actually 12% is the top rate.
I think
S
above a 1.5
Yeah,
billion or something,
yeah,
yeah.
and then another 5% on top of that. Quite quickly, you're paying very significant, stamp
Yeah,
duty
it
on
becomes
pensions.
prohibitive really. It's
I mean, you could argue that this is a first world problem and that people who can
yeah.
afford to buy a second home, that's why they've been targeted. But I think that was quite a surprise to people.
Yes, I mean, there's lots of criticism of stamp duty in general because it kind of gums up the housing market.
Mm.
But we do have a problem of housing supply, and so they want to disincentivize second home ownership. So that's that changed. More tax raised there. There were some changes that we didn't get that were definitely talked about ahead of the budget. Tax relief on pensions
Mm.
and tax-free cash, two things that were being very fretted about.
Yeah.
Didn't happen. Doesn't mean they won't happen because there's still further changes to the retirement
Yeah,
system.
there's a pension review underway, so we don't know how that's going to pan out. But both of those were significant concerns for people. So, I mean, as we know, currently you receive tax relief at your highest marginal income tax rate. So it's a very generous perk for higher earners. And so I think in the context of what the chancellor had been talking about in the run up this, it was not an unreasonable assumption that she might target uh, a higher rate tax relief. I think it would have been complicated for her because of higher earners in the public sector,
Yeah,
high earning teachers, doctors, consultants, etc. So I think that maybe high earners in the private sector probably have those people to thank for that reprieve. The other one, which was a real focus ahead of the budget, was the tax free cash. I think it's called the pension commencement
lump sum.
lump sum.
Hmm.
Yeah. So this is the 25% that you can take tax free when you start to draw down your pension. I think many people feared that was going to be, if not abolished, then limited,
Yeah,
maybe to £100,000, and in some ways, that would not have been unreasonable because I think the average pension pot for a 55 to 64-year-old is just over £100,000. So most people don't get anywhere close to using up the whole of the maximum allowance, which is just over £268,000.
hmm
Most people just don't get anywhere near to that. Um, uh, but so I think there's considerable relief that is still in place.
there's a pensions review which is ongoing and will report back on some of these things. So they're not off the table. As you say, that issue around the public sector probably it definitely makes things difficult for them.
Mm.
This sort of related to this, we talked about the national insurance change. There's a carve out, isn't there, for public sector employers. So yes, there's a higher rate of national insurance for their employees, but the government is writing that off because ultimately it's the government that pays that sort of thing. So
Yeah, well, exactly. It would be giving with one hand and taking with the
it
other.
would be much harder to do that in the case of, say, tax-free cash or pension tax relief, and to somehow exempt
Mm,
final salary or public sector pensions from that. That
mm,
would be very, very two-tier,
mm, mm.
if they were to do that. Something else that didn't happen, and Rachel Reeves referred to this in her speech: no extension of the freeze on income tax bands, which
Yeah.
I'd actually wondered if they were going to make this change because it felt like a quite kind of low resistance way of raising lots of money, would skirt their promise around income tax pretty closely, but they could have done it. She acknowledged that they could have done it, but said she wasn't going to do it. That means that we've got a freeze for a couple more years, but after that, income tax bands should start rising again with inflation.
Yeah, so I mean this was the closest thing to the fabled white rabbit that chancellors always sort of pull out of the hat. I mean, I don't think it really was, but I mean, income tax bans have been frozen since 2021, and they're due to be frozen until 2028. So we kind of got used to this so-called fiscal drag
Yeah.
of the rates staying still as people's earnings rise. More and more people get dragged into higher rates of tax. So there was speculation that she would extend it for another couple of years to 2030, and she chose not to do that. Um, which is welcome, because fiscal drag it's a very significant, it's a very easy way for governments to raise
Raises
money,
huge amounts of money.
raises a lot of money without anyone really understanding what's going on. So you
Yeah.
can see why they do it. So actually, I think that this was quite a positive development that she's now. We're going to see those allowances or those thresholds rising in line with inflation in 3-4 years time.
Okay. Well, let's leave it there, Tom. We've covered absolutely loads. If listeners do want some more comprehensive coverage of the budget, we've got a couple of articles up on the Markets and Insights section at fidelity.co.uk. There's an excellent article on the winners and the losers from the budget. That's by our colleague Richard Evans. I've written a bit more on the implications for pensions and IHT. Those articles should be up very shortly. But Tom, that is all the time we have for now. Thanks for joining me.
Thanks, Ed.